Exchange-traded funds, or ETFs, are some of the most popular types of pooled investments in the finance world. And much of their popularity comes from their unique diversification and trading strategies that provide them with relatively low risks and high liquidity. Investing in a range of similar investments, such as the technology sector, an exchange-traded fund or ETF seeks to make money by tracking the performance of a certain index, sector, commodity, or other asset. ETFs are an excellent way to add diversity to your portfolio and are a formidable weapon on your investment toolbox. Having a few ETFs is a tried and true method that can help you reach your financial stability and investing goals regardless of your level of experience. Welcome to Luxo-Life, your partner toward personal growth and success. In this video, we're talking about ETFs, but since we've already made a couple of other great videos about this time we're focusing on the 3 best ETFs to date that can make you rich. However, let's just all remember that there's no such thing as an overnight success, meaning that you should always focus on the long-term benefits of investing rather than the invest today, get rich tomorrow scam. Like any other type of investment, ETFs are just a part of your wealth building strategy and also come with risks of their own. The path to lasting success and wealth is a combination of strategic investment, multiple baskets, smart choices, and the tenacity to keep learning and growing despite failures and opposition. With all that said, relax, take notes, and watch until the end. Let's get started. Number 1. Why ETFs are a good investment. The instant diversification that ETFs provide is one of their greatest advantages. Essentially, investing in an ETF is purchasing a portion of a diversified portfolio that may include stocks, bonds, commodities, or even real estate. Because of this, the impact of a single asset's bad performance is lessened since risk is distributed over several investments. It's akin to not putting all your eggs in one basket, a fundamental principle of investing. Next, we have liquidity. Liquidity refers to the ease with which you can buy or sell an investment. Like individual equities, ETFs are very liquid since they trade on stock exchanges. ETF shares allow you to purchase and sell at any time during market hours, giving you flexibility when making investments. Contrast this with some other investment options like mutual funds, which typically have a once-a-day trading window. ETFs are also renowned for their cost effectiveness. In general, their expenditure ratios are smaller than those of mutual funds, which over time may reduce your returns. These lower costs translate into more of your hard-earned money working for you. You get the benefit of professional portfolio management without paying hefty management fees. Transparency is crucial. ETFs provide a level of transparency that's appreciated by investors. The underlying assets within an ETF are visible in real time, allowing you to track the performance of your investment easily. This transparency enables you to make informed decisions about your portfolio at any given time. One of the best things about ETFs is that they are tax efficient. When it comes to the formation and redemption procedure, ETFs may yield lower capital gain dividends than mutual funds. This can lead to a more tax-friendly investment experience, and you won't always have to look over your shoulder for the IRS. Number 2. How to invest in ETFs. Now that you know what you're dealing with, here are some tips and rules to remember when investing in ETFs. Tip number 1. Avoid buying multiple ETFs within the same category. If you already have ETFs in the technology sector, consider buying ETFs in commodities like gold. This strategy promotes healthy diversification. Tip number 2. Set clear and specific investment goals. Different ETFs are beneficial for different investment horizons. If you're aiming for long-term capital appreciation, then purchase ETFs that are risk-averse and have a steady growth profile. If your goal is to create an effective cash flow, then focus on more flexible ETFs. Tip number 3. Stay consistent. Create your investment routine that would allow you to automatically invest a convenient amount on set periods. Regardless of market stability, consistent investments benefit from the power of compounding interests. Number 3. The top 3 ETFs to invest in. Finally, here's what you've been waiting for. Let's talk about the best 3 ETFs that can help you grow your wealth. Remember, always keep an eye on these ETFs as they can play a pivotal role in optimizing your investment portfolio, providing you with opportunities to diversify, hedge against market volatility, or align with specific investment objectives. Number 1. S&P 500 and Total Stock Market, Vanguard Total Stock Market ETF or VTI. VTI is a versatile ETF that provides exposure to the entire US stock market. It boasts an impressive portfolio of over 4,000 individual company stocks. This breadth of coverage means that when you invest in VTI, you essentially own a piece of the entire US economy. Additionally, VTI's exceptionally low expense ratio of just 0.3% ensures that more of your investment returns stay in your pocket. Over the past decade, VTI has demonstrated solid performance with an average annual appreciation of around 11%. It's a great option for long-term investors looking for broad market exposure. VTI has a rated above average risk category of grade D. This means that in comparison to other ETFs in the same category, VTI has a higher volatility. ETF number 2. Growth ETF. Invesco QQQ Trust or QQQ. QQQ focuses on high-growth technology companies, making it an appealing choice for those seeking substantial capital appreciation. Within its portfolio of over 100 company stocks, you'll find prominent names in tech, such as Apple, Amazon, and Microsoft. Despite a slightly higher expense ratio of 0.2%, QQQ has delivered remarkable returns, averaging nearly 16% annually over the past 10 years. This ETF has thrived on the growth of technology, particularly during the tech boom accelerated by the pandemic. As with any high-rewarding investment, QQQ also entails a higher risk category with a grade F. This makes it even more volatile than VTI, but the fund is promising, and if you play your cards right, this ETF will prove a strong and growing addition to your portfolio. ETF number 3. High Dividend ETFs, Vanguard High Dividend Yield ETF or VYM. If your investment strategy centers around generating consistent or passive income, VYM is an excellent option. It focuses on high dividend yield stocks primarily from established companies with a track record of paying dividends. With a solid dividend yield of around 3.39% and a low expense ratio of 0.06%, VYM provides income-focused investors with a reliable stream of dividends. Over the past decade, it has maintained an average annual appreciation of approximately 10%. This ETF is particularly attractive for those who want to enjoy both the income generated by dividends and the potential for modest capital appreciation. What's more is that VYM has below average risk rating with a grade of B. This income yield is much lower than the previous two, but again, if long-term capital appreciation is your ultimate goal, then consider adding this ETF to your portfolio right now. Number 4. Who should invest in ETFs? I'd say everyone should, but not everyone will think of ETFs as their bread and butter. So the question is more likely who should primarily invest in ETFs. First of all, beginners. ETFs are an excellent starting point for novice investors. Their simplicity and built-in diversification reduce the learning curve, making them an accessible entry point into the world of investing. Novices can begin building diversified portfolios without the need for in-depth market knowledge. Second, long-term investors. For individuals with a horizon measured in years or decades, ETFs are a fitting choice. Their stability and diversity align well with long-term investment goals. ETFs can be valuable components of retirement portfolios or other financial objectives that unfold over extended periods. Third, passive investors. If you prefer a hands-off approach to investing, ETFs are a perfect match. Their passive management style means that you don't need to engage in active trading or constantly monitoring your investments. You can set and forget your ETF portfolio, periodically rebalancing it to align with your desired asset allocation. Lastly, stable income seekers. Those who seek a regular income from their investments should strongly consider dividend-focused ETFs like VYM. These ETFs provide a consistent stream of passive income, making them appealing to retirees or anyone seeking cash flow from their investments. Exchange-traded funds or ETFs offer an exceptional avenue to diversify your investment portfolio and achieve your financial goals. They provide a powerful combination of diversification, liquidity, and cost efficiency. As you consider your investment strategy, keep in mind the distinctions between ETF and individual stocks. Remember, the top 3 ETFs we discussed today offer a range of opportunities for various investment goals. We hope this guide has shed light on the potential of ETFs in your investment journey. As always, further research is key to making informed decisions. To stay updated on our latest financial and self-development content, leave a like, subscribe, and hit the notification bell. Thanks again for watching.